Welcome back to Sonoma Brain Trust. We're a group of professionals here in Sonoma Valley who get together on Zoom once a week to talk the markets, changes, and up and coming things that might impact your business and your life. Today joining me, I'm Daren Blonski, and I have Chelsie Runnings and Mary Piasta, all of us coming from different professions and different perspectives. So we're going to start off today with Chelsie Runnings, who is a local real estate agent, and give us an update on the real estate market and what we're seeing.
Thanks, Daren. I feel like a broken record, constantly talking about supply and demand. We have more demand than we have inventory. Our market is moving. We have right now 124 properties on the market in Sonoma. It's about a 27% decrease from last year. This time we saw 170 properties on the market. Prices are staying steady. In fact, we are seeing some price increases in areas like Petaluma, where they saw a 3% increase in sales prices in April compared to last April. And again, another week, I know I keep saying this week after week, mortgage applications have increased double digits. Again, those buyers are out there taking advantage of those low interest rates. So we are seeing slight delays in closings, more days on market, not necessarily because of the buyers having issues, more with the industry trying to adjust. Appraisers and home inspectors trying to get out there and work around not having contact with people or being in the house. So that's added to a little bit more days on the market, but overall we are seeing life in the market. It's not crashing. Buyers are out there wanting to take advantage of those low interest rates, and we need more inventory.
Great. So curious, we need more inventory. When you see a market, or I guess the prices go up, like you just said they did in Petaluma, how many houses getting sold does it take to push that price up? Or is that possibly from 3 or 4 houses that were really large houses and really expensive that push that price up?
Well, right now, 63% of our inventory is $1 million and over. And that's been pretty consistent over the last year. I'd say over the last 2 years, our inventory has stuck around 60% being around $1 million and above. So when I say they're staying steady, that's what I mean. Like, we're not really seeing any massive drops under the $1 million. For Petaluma's been a hot market for the last year. We've seen a lot more people buying over there. So I think, larger quantities of homes are being bought and higher demand, which is increasing the value over there. More overbiddings happening in Petaluma right now. You can get a little bit more land for slightly cheaper than what you can get it here in Sonoma, and then a quick jump onto 101.
It's interesting. I'm hearing a lot of people rumbling about moving out of LA, moving out of San Francisco. We're done with the, city life after COVID. It's just not worth it. Now we're all on Zoom, and that looks like the future, especially if you listen to our video we just did with Mary Wright that talks about all the complexities of workplace monitoring. Now we have to monitor people's health. You just some point say, hey, I'm going to go live out in the country. And I wonder if that's going to really drive up prices in these areas like Sonoma and Petaluma that are still commutable to the city a few days a week, but not necessarily every day.
Yeah, especially as people want to have more space, less densely populated, and as the remote workplace continues, I definitely expect that we'll see a lot more home buyers coming from the cities to take advantage of the prices, not only just the prices here, but also the space they can get for the price.
It'd be great to see an influx of young families into Sonoma, to kind of build the full-time population.
It would be nice to have that opposed to all the vacation rentals. A large percentage of vacation rentals I expect we'll probably see going on the market as well, because, they have no one paying those bills for them right now. I don't see people picking up traveling as much either.
Yeah, I spoke with Madeline Yankee over at Woodfield Properties, and it's really fascinating when you talk about just the shutdown, absolute complete shutdown in long-term rental or in short-term rentals.
Well,
right?
It's banned. So
yeah.
until the ban is lifted, then that whole line of income opportunity for people is gone. But Chelsie, are you guys getting calls from those folks who are deciding not to convert their short-term rentals into long-term rentals and are rather wanting to test the market right now?
I've heard of a couple. So as you guys know, I primarily do probate and trust sales, and my business has kind of slowed down just because the courts have been closed. But I do have some colleagues who are getting people who have been calling wondering if it's the right time for them to offload those second properties that they have that they can't do anything with, or, if they're weighing their options on getting a forbearance on one mortgage and then they have this other property that's not having income producing months to be able to cover the mortgage, they're definitely calling to see if now's the time. I did actually have 2 calls today from people who don't live in the area and they inherited properties, and they were just wondering now if they should just sell it now because of the market or if they should hold off. And like I said, the supply and demand, it's really keeping those prices steady, and even in some places increasing those prices.
In the investment world, we talk about something called recency bias all the time. And whenever we have events like this, our recency biases creep in. We say, well, it was like this last time, so this is how it's going to be this time. And I think definitely coming into this crisis, everyone was like, oh, real estate's going to go down, let me gobble it up. And it doesn't seem at this point we're going to see real estate really go down. It'll be interesting to see once bankruptcies, and so we'll use that as a smooth transition over to you, Mary, is bankruptcies really move up, and will that impact the cost of housing and the prices of housing in the area?
Well, I think we're starting to see some of the larger corporate bankruptcies that we're all hearing about on the news or in the paper, but I'm not seeing a big influx of these small, business bankruptcy yet. It seems that more the pulse is that businesses are focused more on attempting to reopen and develop concrete strategies for doing that. And it's very complex right now. But circling back to your question, Daren, the correlation between bankruptcies and real estate, will that happen? I'm sure we will find out.
Yeah, it'll be interesting to see. A lot of these bankruptcies we're seeing in they're Chapter 11 bankruptcies, from my understanding, and certainly confirm, Mary. But Chapter 11 is just more protection. It doesn't mean you're going to close the doors. Chapter 7 means you're locking the doors and boarding up, right? Or is it different the other way around?
There are different types of bankruptcies, and I'm not prepared to dive into the differences between them today. The recent legislation also created another subtype of bankruptcy under Chapter 11 that I understand businesses are looking into on the broader scale. So,
cool. Maybe next time or another time we can catch up on those differences. I just wanted to point out, I think it's really important that when you read the headlines, it says JCPenney's is going bankrupt. I mean, that doesn't necessarily mean that they're boarding up windows and there's no more JCPenney's. Sometimes, and as President Trump has pointed out, you use bankruptcy as a business tool.
Oh, bankruptcy can absolutely be a business tool, much like an employee handbook is something that you create to identify your employment policies, but also to use defensively in the instance of litigation. So with respect to bankruptcy, if you look at the JCPenney example, they are planning to stay reopen. They're even looking into other types of ways to recraft their business model in doing so. But I'd like to talk a little bit about what's happened this last week in the court system, and that is that here in Sonoma County, we're having more openings of the courts. The courts are doing hearings via Zoom, which means that processes are going to go forward more, which is also raising questions for businesses about potential other areas of liability. And one area of liability that people are looking at is tort liability. And this is going to potentially come up in the employment situation as businesses reopen, and there's this fear that maybe a customer, an employee will contract COVID and then draw a causal line back to the business, and that creative plaintiffs lawyers will then try to make a lawsuit out of it. So A lot of what in that instance that's going on is that there would be a very high standard that would have to be proven. So I think businesses in general can rest assured that if there were to be some type of claim like that, there would have to be the proof of that causal line in such a way to directly identify it. And that doing so is going to be very difficult, especially proving it at that specific location. So I think it becomes really important as businesses look to reopen that they consider this liability mitigation thing, especially in light of potential tort liability and the interest out there in the plaintiff's bar, and that they take extensive measures to not only implement appropriate policies, like we heard Mary Wright speak in one of our prior videos. She's an employment law specialist, and that businesses do take it seriously.
Hey, Mary, I know our whole idea of facts over fear, so I don't want to be creating fear, but would it be plausible to expect that as businesses open up, we will start to see more litigation for employees or even clients saying that they got sick or they were in unsafe work environments, and that's why this would be so prudent for businesses to follow these risk mitigation procedures?
Absolutely. I think we're going to see it in both ends. I think the employee claims will mostly be channeled through the workers' compensation system. So really the larger bucket of potential exposure are the customers who, or vendors or the other people who would be potentially outside of that system. So that's where, directing that causal line can be more attenuated, and also businesses having firm policies in place, looking at their policies, beefing up their employment handbooks, drafting really proactive things now, and then not only that, but implementing them, taking records so that they can be able to prove later on, look, we did all this. I think that will go to show that the businesses did attempt to mitigate this, omnipresent virus.
I'm just waiting for those commercials. Have you been exposed? Were you exposed to somebody with coronavirus 15 years ago? Give us a call today.
Right? Yeah, I'm sure they're coming.
Waiting.
Right? And yes, facts over fear. So there's a lot businesses can do right now to really put things in place to mitigate against that, and also create a safe place for their employees. And I would encourage any business who's viewing us to look back to the video that we published that features employment law specialist Mary Wright, where she has some very thoughtful comments about what businesses can do right now.
Awesome. And as we're opening up, Daren, are you seeing changes in our financial markets, strengthening or weakening, or what are you seeing now that more counties and states are taking these phases up a notch?
Yeah, you're certainly seeing some tailwinds come into the markets. It's possible now, and I'm going to go ahead and share my screen just to talk about this, because half the world's visual and I'm visual too, and it's hard to talk about these abstract things without some pictures. So let's make some pictures on the screen. So what you see in front of you is the SPX, which is a proxy for the S&P 500. It's the largest 500 US-based stocks. And this is, you can see this top of the, this was February 19th, the low, or the high, the low was March 23rd. This is where we're at today. And there's some important lines I have drawn on the screen for you to help understand and create meaning from this chaotic little chart. So what you see is the green and the red. Anytime you see red, that means the market traded down. Anytime you see green, that means the market traded up. And what you're looking at is candlesticks, and candlesticks are a function to help us understand time in the market. And so during a period of time, the market either traded up or down. And in this chart you're looking at on the 4-hour scale. So this basically is the market broken up into 4-hour segments. Now this is the SPX. That means it's traded 23 hours a day around the world and global. I like looking at this a little bit better, and I like looking at SPY, which you might be more familiar with at home. And you hear about on the news a little bit more because it's a broader index. It's the world trading this index. And interestingly enough, we've seen in the last month or so, a lot of the green big moves up have come in the London hours, which are the early morning here in the US when our markets aren't trading in New York. So you'll notice, let's talk about these dotted lines first. These dotted lines are something called Fibonacci lines. They're mathematical lines we use to measure retracement of the market. So the market starts up at the top, goes to the bottom, which is 0, and then a retracement line. And you'll notice this 61.8 retracement line, which we're out on that dotted line, is really important. It's typically where we see some what we call overhead resistance, where the market really has to work hard to go up further. And we keep hitting that. And we just hit it. And it looks like we might have flipped it over last night. So that was early in the morning, and that might be a really positive sign. However, the market is the king, queen, however you want to look at the climax of trick and trade, and it will trick you and make you look like a fool to anyone. So anyone that approaches the market without a little bit of humility at least is going to end up with a pie in their face. So you'll see these dotted lines, and you can see we've been working that 61.8 Fibonacci line pretty hard. And it looks like we might have broken up and it flipped it over. So when the market's coming up into a line, we call it resistance. When a market is bouncing off a line, we call that support. And so when the market goes up, it works in a geometric way, and then these Fibonacci lines help us to understand the retracement. It's very normal in an economic situation that we've gone through with COVID-19 to have an initial sell-off, to have a retracement, and then a further sell-off. That's the big question no one knows, right? So we watch these indicators to try and help us understand further. You hear in the news people talking about a V recovery. Certainly the tech world has seen somewhat of a V recovery, but the rest of the market's pretty well lagging. So let me zoom in now before I put everyone to sleep, and I'll just show you a few more lines. So this line here is a really important, it's been support for the market as we've been going up, and you can see it was resistance here, and then we bounced above it, gapped above it, we call, and then we turned into support. And it's been support now all the way since April 8th, so quite a while now. We did break it last week on May 13th. We went below, which was a really bear sign. And bear is when we think the market's going to sell off. And then it said, no, just kidding. And then over the weekend, there was an interview with Jerome Powell, the chair of the Fed, on Sunday, and he talked about how the Federal Reserve basically is going to print as much money as we possibly want and help us do whatever we need to do to keep these markets healthy and moving along. Interesting, Jerome Powell pointed out in his interview that when the interviewer asked on 60 Minutes, well, did you print the money? How do you make the money? And he goes, we just print it digitally. So you think about that and you're like, well, wait a sec. Does that mean you guys just like add a 0 to the end of the bank account at the Federal Reserve? Like, yeah, pretty much. That's what that means. So, they print money too, but in this case, when they're putting money into the system, they're basically trying to flood the system. And the idea is if they flood that system, then all of a sudden the money is going to start changing hands in the economy. And you've certainly seen that when you look at like consumer discretionary spending. When everyone got their checks, guess what? They went out and spent it. And no surprise there. So we're seeing those type of stocks do very well, whereas some of the other stocks that might seem more boring to people are not doing as well. So what happened last night is you can see this resistance line, this long-term trend line, this green line I'm pointing out right now. If you go all the way back and track that trend line, it was an important support line all the way back in January 7th of this year. And lo and behold, that line holds to be important now, and it appears like it's now flipped and become support, which is a good thing. It's possible we might get out of this kind of trading channel we've been in and flat top. But you can also see here, we are into some thick resistance right at the 2980 level in the S&P. It's got to break that, right? That's some really strong resistance, and it's right in the neighborhood of that 61.8 Fibonacci line. So there's a lot of resistance here. It's going to take some oomph to get over. We're seeing the economy open. We're seeing things happen. Big factor, right? The big factor we've got to look at is, do we have a second wave, right? As things open, did more people get sick? Did the numbers start spiking? That would really be a difficult drag on the economy. Even if we open and even if we have no more COVID virus second round, it's still going to be a difficult economy. Enough people have lost their jobs now. We're expecting somewhere in the tune of 40 million people will now file unemployment claims come Thursday. So hold on to your seats. We're not out of the woods. Keep washing your hands. Let's hope for not a second round of COVID. as Mary Piazza was saying a few minutes ago, Mary Wright, who we interviewed in another video, I mean, the amount of regulation now in place to protect your employees and your clients from COVID virus, and the obligations and the liability that businesses have is definitely going to drag this economy. It's going to be a slow slug out. And so keep doing what you're doing to protect your wealth. And we'll leave it there for today.
Thanks, Daren.
Well, that's it. So that's a wrap. We don't want to go too much longer. We like to keep these things somewhat chewable. Chelsie, any final thoughts? Mary, final thoughts?
Market's alive. The real estate market, it's alive. It's well. Those mortgage interest rates are still historically low. So take a look at those if you're interested in getting a mortgage and you can pay your bills. Take a look at those interest rates while they're still low. And if you're thinking of selling, it might just be the time to put it on the market.
And for businesses, again, get out your employment policies, brush them off, make sure they accurately reflect what you're doing, what you need to do, get advice on that, and let's be positive, people.
That's right. Thanks, Mary. Thanks, Chelsie. Good to see you guys as always on Zoom, and we'll see you next week, same time, same place.
Bye, guys.
Let's start a party.